This is Amit Pabari, founder and managing director of CR Forex. Last week we were not able to publish a video because there was a puja at our new house, because of which you can see a new background also. In last 15 days, we have seen huge volatility in equity market and currency market, especially after Jackson Hole meeting. After Jackson Hole meeting, two things are very clear. First thing is US economy is doing extremely well as compared to other major economies in the world. Second, as US economy is doing well, Fed is going to increase its interest rate aggressively in coming months. Now, if that happens, let us see what impact it will have on the market. If Fed is aggressive in the rate hike, then there are four impacts. First, dollar index from the current level of 109.60 will move towards 112. That is the first target, and we are expecting it to move towards 115 level also. Second, equity market across the globe will not perform well. Nifty, which is currently trading close to 17,500, can move towards 16,500. Third, bond market, it will have a negative impact on the bond market. US Treasury yield will move towards 3.5 to 3.75% in coming days. And lastly, all emerging market currencies will have pressure, and so the Indian rupee also will have pressure. Now let us discuss outlook for dollar rupee pair. Two factors: one, dollar strength, and second factor, trade deficit for the month of August was also close to 28 billion. These two factors are giving a clear-cut indication that the appreciation in the pair is limited towards 79 to 79.20 level. Even because of some reason appreciation happens, say because of inflow or RBI selling, any dips because of appreciation should be taken as an opportunity to buy dollar. Overall, for a few days, we expect the dollar rupee pair to trade in a range between 79.30 on the lower side to 80.20 on the higher side. Once 80.20 is taken out, then the pair will move eventually towards 80.5 to 81 kind of a level. Now let us discuss strategy for thin margin exporters. Thin margin exporters like agri exporter or chemical exporter, they are taking costing between 79.50 to 79.70 kind of a level. For them, we are suggesting that they should ideally cover 75% of the confirmed order between 79.75 to 79.90 kind of a level. For remaining exposure, they can wait with a stop loss of 79.50 for a target of 80.20. Now let us discuss strategy for thick margin exporters. Thick margin exporters like textile exporter or an engineering exporter. As the overall trend of the pair is on the weaker side, because of that, last week we suggested them two ideas. Idea number one was to maintain a hedge ratio between 45 to 50%. For if the hedge ratio has fallen down, in order to participate, they can participate close to 79.70 to 79.90 level. Now for coming days, the hedge ratio has to be same between 45 to 50%. If the hedge ratio come down, they can ideally target to cover between 80.20 first level, 80.50 next level, and 81 final level. They can wait for this level with a stop loss of 79.10 kind of a level. Now let us discuss strategy for importers. RBI has really managed the currency well despite dollar strength, but importers should not get complacent. An ideal strategy for any kind of importer is that buy on dips. If anyone has not hedged their import for next 30 to 45 days, any dips towards 79.30 to 79.50 should be taken as an opportunity to cover their imports. Now let us discuss trading ideas for coming days. 2 weeks back, we had given some call on selling Euro USD and selling GBP USD. Last week we said book 75%, and for remaining 25% you can wait for the target. Now last week those targets were almost achieved. So if anyone has traded on that call, on Euro they have made close to 1.5 lakh rupees, and on pound they have made close to 1.75 lakhs. Now for this week, the idle trading idea is sell GBP USD between 1.1580 to 1.16. Target is 1.1420 and stop loss is 1.1675. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.